The Fed hiked rates by 25 basis points today. What did they say? What are the implications on the economy? What can we expect from Jackson Hole? And why is the Fed playing with fire? Welcome back to the Bitcoin Layer. I'm Nick Bhatia, and in today's episode, we're going to break down what happened today with the Federal Reserve's FOMC meeting. Let's start by talking about what they did. So, the Fed raised rates by 25 basis points, as was expected by the market. The Fed has now increased rates by 525 basis points since the beginning of this hiking cycle. The Bitcoin Layer is sponsored by River. Make sure to check out river.com today or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today. So what did Jerome Powell, the Federal Reserve Chair, have to say today in the press conference to justify this rate hike? He said that the labor market is still very tight. Okay, and that is his main message here, and why the Fed is continuing with its hawkish rhetoric and why it will continue to pressure the market with the threat of more rate hikes. Okay, so what has happened recently that has emboldened the Fed to continue on as it is delivering these hawkish both hikes and messaging? Well, over the summer, we basically have had an upside surprise to the economy. This has come from a few places. Number one, GDP itself, 2%. Okay, so there's no sign of recession going on in the US economy. That is number one. Number two, the unemployment rate still well below 4%. Now, with these two main headline factors of low unemployment and positive economic growth, the Fed can basically ignore, from a headline perspective, everything that's going on in the economy that has a negative slant. Because it's looking at the economy, it's looking at a lot of metrics, and it's saying that the most important thing, which is that unemployment is not skyrocketing and the economy is still growing, those things are at play. We have contraction in lending, we have disinflation, we have contraction in prices paid at manufacturing firms. Overall, manufacturing is in contraction, but all of those things we can look past because what we are focused on are the strong economy and the tight labor market. Now, the tight labor market is going to be supportive of wages, which will be supportive of inflation in the economy. And so we cannot let our foot off of the gas pedal. That is how the Fed is approaching the market today. And that is why the Fed decided to hike rates again. And now it is leaning toward potentially another rate hike in September or November. We're not sure when, but the rhetoric is slanted toward hikes. Now, what is next for the Fed? The Fed's next move is a speech in Jackson Hole. So every August, central bankers gather together and deliver their latest policy remarks and thoughts on the future. Now, last year at the Federal Reserve's speech, when the Fed chair Powell decided to deliver this message, he came with a forceful tightening message. We are going to be forceful on inflation. We are going to go after it. And the Fed ended up going with 75 basis point hikes, and several of them, to really get this forceful message through to the economy. So do you really think, 12 months removed, the Fed is going to give any sort of pivot to its message in Jackson Hole? In fact, the opposite, it's going to reinforce This is why we've been forceful. The job is not done. We are looking at a tight labor market, and there's no reason to give any hint of dovishness, meaning we are not going to give any credence to the argument that the economy is actually quite weak and we might need to be accommodative, meaning lower rates time here in the near future. So that is what the market is up against. And the Fed wanted today to make sure the market is positioned for more hawkish dialogue in Wyoming in August. The Bitcoin layer is sponsored by Foundation Devices. Now, we all have talked about the dangers of letting your coins stay on an exchange. The importance of withdrawing your Bitcoin to self-custody is really part of understanding what Bitcoin is all about in the first place. Bitcoin is about avoiding centralized financial institutions. And with Foundation Devices, we are showing you guys an amazing device. It's called the Passport. And with the Passport, you can get your coins off of exchanges into custody with this beautiful, easy to use device. They also have an onboarding service that will help you get settled with your device, get comfortable with it, get to understand what it is like to actually take custody of your Bitcoin. So check out foundationdevices.com today and make sure to pick up a Passport and use the promo code BitcoinLayer for $10 off your device. Now, we had a dramatic re-steepening of the curve in March, and we flagged that as meaning that cuts are coming. Now, why were we early to that call? Well, it basically has to do with the response from the Federal Reserve and the Treasury Department, the US government. We came with new bailout facility that protected losses on Treasury securities. This is called the BTFP. That introduced liquidity into the market, and we also had Treasury coming with essentially the promise of unlimited deposit insurance. So raising that FDIC insurance amount from $250,000 to essentially infinity. Okay, this was an implicit guarantee by the government through its communication that no bank depositors would go under. So instead of a banking crisis, instead what we got was an orderly unwind of small to medium-sized banks and a takeover by large banks and a guarantee of FDIC insurance to anybody that was facing potential losses, and a Fed facility to assist in this orderly unwind. And so with the orderly unwind of banks, we really avoided any need for the Fed to come in with accommodative monetary policy. So this was why cuts that were starting to be priced in 2023 are now nowhere to be found. Now, US Treasury yields have been trading below the policy rate for quite some time, and we understand that rates have been a little bit wrong on being early to the mix here and calling for cuts. But we believe that it is still very prudent to take into account the fact that Treasury yields are lower than the policy rate, especially in the 2-year part of the curve. Now, with 2-year yields right around 5% or slightly under 5%, and the policy rate now above 5.25%, the market is telling you that it doesn't think runaway policy rates are an odds-on favorite of happening. So that means the market believes that over the next 2 years, policy rates will drift down. We believe this is the most important signal to take away from the overall market right now. With all the data coming in, some of it being very supportive of a strong consumer, real estate prices potentially bottoming, but manufacturing and lending in contraction, the balance to the economy is giving really mixed signals. But from the market's takeaway, the Treasury 2-year yield still trading below federal funds, we believe is an important signal and something to take away when looking at what is going to happen over the next 6 to 12 months with the economy. We believe the Fed is playing with fire now, going with further hikes just to give itself room to cut rates in a downturn is we think, a very dangerous proposition. The full effects of tightening have not made their way into the economy yet. So while we believe it would be wise to pause and wait and see how the economy is going to react to higher rates, the Fed is not doing that. They still think the risk is to higher inflation. Okay. And so we believe that is potentially dangerous and can have very large ramifications on the economy going forward, but we'll have to wait and see what the result of the Fed's tightening is. It leaves us nervous with the implications on the US economy, and that's why we believe the Fed is playing with fire. Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at The Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.